Hi guys! Today I want to talk with you about a real important topic. How to invest in your 20s. Well, it was always really important for me to be able to become financially independent. I have gained a lot of experience in the last couple of years regarding this topic. So make sure to stay till the end of the video to really get all the information and awesome investing tips for beginners I will share with you. Before you want to start investing and go for it, you need to take a look at your finances, and I highly recommend following the following steps. First and foremost, it is very important to have an emergency fund. I also talked about this in some of my other videos, and I bet you already heard of it, right? This is just a really great rule to follow. You can never know what's going to happen. We are literally living through a pandemic. If that does not show you that you need emergency savings in case you lose your job or something, well, nothing else can, right? It's recommended that you should at least have a month of money in your savings for an emergency. Then you should slowly grow that fund to 3 months and finally 6 months of saved money in your fund. I personally would also recommend 1 year of savings, but this really depends on you. The next step would be paying off your debt. You should always pay off your debt as soon as you can, because this will set you back in the long term. Any high interest rate debt, you want to get rid of that before you start making any big investments, because that's just money that is going to keep going down the drain if you don't address it. So just pay it out. The third step is opening a retirement account. And maybe I will make a whole separate video on this again. I'm a passionate advocate of starting your retirement as soon as possible. I personally started mine some years ago. So basically, there are different types of retirement accounts. Some of the more popular ones are 401ks and Roth IRAs. So 401k is generally set through your workplace. If you're working a 9 to 5 or some other type of job with benefits, there is a high chance you already have a 401k retirement account. A 401k in itself is an account that holds investments. So if you have a 401k through your job, you are investing and you are doing great. You are preparing for your future. 401k is a tax advantaged retirement account where you put money in and your company is going to most likely match to a certain percentage. How much money you put in through this, you are automatically being invested in a mixture of stocks and bonds through mutual funds. There are also Roth IRA accounts, which is another retirement savings account that allows your money to grow tax-free. So first, let's break down some of these terms. If you are new to personal finance and unfamiliar to stocks, bonds, or the stock market, let's talk a little about it. I will keep it as simple as possible. A stock is an investment that represents a share in a company. Let's take Facebook for example. You can buy a stock of Facebook, which means you basically own a little piece of Facebook's big pie. And so as that company grows, your stock is going to grow slowly with Facebook. The stock market, that you always hear people freaking out about, is the marketplace for stocks and where stocks are held. So it shows all the different shares of company ownership and how they are performing overall. The interesting thing about the stock market is that it's generally controlled by investors' emotions. People are starting to freak out because, let's say there's a pandemic or so, they are going to want to pull the money out and sell those stocks and shares. If a bunch of people do that at once, that's going to cause it to drop. But then as soon as they are starting to feel like this is a good time, I'm going to reinvest my money in the stock market is going to go back up. You often hear people talking about investing with risk versus reward. You are going to have risk more if you want a higher reward and want to try to get more money. But there's also the opposite of it, a lower risk investment, which means you're going to have a smaller reward profit margin. So you are going to make less, but are also risking less as well. A bond is something that falls in that kind of low risk category. A bond is a contract with a company or the government. They're essentially loaning them your money. And so it's very predictable, and over a long period of time with that loan, you are going to make a little bit of money out of it. So it is considered a low risk. Investment fund is basically a big old bowl of stocks and bonds. One had a real good explanation. The person explained that buying a stock is like buying one single flower, but buying a fund is like buying the whole damn bouquet with all the bunch of different flowers. So there are different kinds of funds, and the ones I'm going to be talking about primarily today are index funds and mutual funds. Mutual funds came along first, and like I said earlier, a fund is a big old bowl or bouquet of stocks and bonds. It is managed by an investor, some very smart guy or girl who understands the stock market is managing a fund or a mutual fund, and they use their knowledge of the market. He or she is selecting which stocks, bonds, etc. they think are going to be the best investment to include in the bouquet. So basically, you're owning a bunch of stocks in one package. There's much more diversification, because if you're to invest in one stock, let's say you buy a whole bunch of Facebook just plummets, all your money is going to go down with Facebook. That's why it's very popular to hear that you need to diversify your portfolio. Basically, don't put all your eggs in one basket. Mutual funds came along for that reason, to be able to invest in stocks, but to diversify across a larger platform. These are run, like I said, by some smart man or woman, and they're going to charge a big old fee, like 1 or 2% of your mutual funds. However, how much money you are putting in there, you are paying them. A little bit later along came index funds. Now, I'm personally a really big fan of index fund, just like Warren Buffett. Warren Buffett, one of the most successful investors in the world. If you don't trust me, trust Warren Buffett. He knows what he's doing. An index fund is a portfolio of certain investments that you can buy into, and then you own a little baby share of a whole bunch of different stocks and companies. So it's similar to a mutual fund, but instead of being run by some fancy manager, it's passively managed by a formula. So instead of like a mutual fund where you are trying to beat the market, you're basically trying to match the market. So the big difference is that you don't have that mutual fund manager. So you're going to cut out a whole lot of costs. That's important. An index fund is something that you usually invest in. You are going to sit on for a while and not touch it at all. One thing to keep in mind is all index funds are mutual funds, but not all mutual funds are index funds. It's kind of confusing, I know. Basically, the way this grows is through compounding interest, which is basically reinvesting your interest into your initial loan or investment. On mutual funds, there's no interest paid, but you might have dividends or capital gains reinvested to compound over time. If you're looking for a compounding interest calculator, check the one on investor.gov. To get an idea of how this would work, let's say you put $1,000 in an index fund and put up a monthly contribution of $100 with a length of time of 30 years. We are going to put out a hopeful 7% every year and calculate annually. Look at the number. You originally put in just 37k of your own cash, and because of compounding interest, it grows to 120k in 30 years. So imagine if you were to put in a higher number of an initial investment, more money each month, or to do an account that has a bit of a higher annual rate of return. And this is why the earlier you start, the better. Okay, so now you should know a little bit more of that terms I mentioned. So we can dive into some of the best ways to invest your money. Now to the good part. Like I said earlier, putting money into a retirement account is a great way of investing. I highly recommend it. The sooner you start, the better. Retirement accounts like a Roth IRA, you should max it out. I believe it's around $6,000 is the maximum you can put in a year. Let's just say you make a ton of money in 1 year and you want to invest a lot of it. You're a little bit limited when it comes to that retirement account. But even if you don't have that much money to put into investment, which I'm sure is quite a few of you guys, don't worry. Just put in a little bit every single month and it will pay off. So make sure you have emergency savings, pay off any old debt that you have and invest in your retirement. Now, let's talk about some different ways to invest. When it comes to investing, like I mentioned earlier, there are different approaches. You might want a more high risk reward. That could be somebody that's trading in stocks and is much more hands-on, and there's also a more passive, a little bit lower risk approach like investing in an index fund. There are different types of index funds. You may have heard of the S&P 500. That's a really popular one. But what actually is the S&P 500?
What the hell is this?
Well, glad you asked. The S&P 500 index basically tracks the top 500 US companies. There are slightly different S&P 500 funds depending on the brokerage account that you sign up with. I personally can recommend you Vanguard, which is a very popular one. Vanguard is the originator of the index fund, but there are many other options to choose from, like Charles Schwab or Fidelity. Make sure to do your own research. Everything in this video, you gotta check it out for yourself. Please do me the favor. Thanks. I would never tell you what to do. I'm here to provide information for you to further learn for yourself. So, Vanguard does not have the best interface. It is kind of confusing to use, but they are a really good place to invest because they have very low expense ratios. So that means if you want to invest in an index fund, you only have to pay them a very small percentage, like 0.04%. There's a story that gives a little more credit to the S&P 500. Warren Buffett bet $1 million that an index fund would outperform a collection of hedge funds over 10 years. A decade passed and he won. So all these different hedge funds are trying to beat the market, trying to time it, to make the most amount of money. They did not win. Putting your money in an index fund and just letting it chill and slowly ride the wave of the stock market did the best. And you don't have to know a whole lot. You just put your money into one and you sit back and don't touch it. So the S&P 500 tracks the top 500 companies, lets you share your little investment across the top 500. I highly recommend index funds. Any decision you make, you have to make for yourself. Put in the time and research your finances. Make sure you are learning for yourself. The goal of them is not to just put money in and then take it out in 6 months hoping that it grows a lot. No, it is about putting in for years and years to come, if not decades, and letting it grow over time and then take it out when you are ready to retire. The best time to invest was yesterday. The second best time is now. It is true, you got to put that money in as soon as possible. You put the money in consistently. You don't even really look at it and just let it grow. Trying to time the market is very hard, and honestly, don't trust yourself. So it's about putting in a little bit of money each month, and like I said, don't touch it. So now let's talk a little bit more about stocks and the potential for higher risk, high reward. So you probably have heard of people talking about investing in this stock or that stock or whatever that may be, and making money and being lucky because they invested in Apple at the right time or something like that, right? So that's when stocks come into play. They are riskier investment, but you're able to make potentially a lot more. It's harder to do and it's going to take time to learn, but there can be really incredible payoffs. The nice part is that stocks in general trend upwards. There are going to be dips and it's going to probably rise 2/3 of the time, then drop 1/3 of the time. So you basically got to stick with it. So if you want to get a little bit more specific, there are some apps out there that are really great. They let you invest a small amount of money from anywhere, so you get a really good feel of the stock market and kind of learn what you're doing and get more comfortable with it. Like I said, index funds are great for a lot of people out there. But if you are willing to take the time and you really want to learn well, then give one of the many trading apps a chance. I'm personally using Trade Republic, but there are many more: Robinhood, Webull, or Charles Schwab. With them, you can learn more about how to buy individual stocks. Of course, as with everything in this video, look it up for yourself. Make your own financial decisions. Trade Republic and Robinhood are very similar from the interface. They are clean and easy to use and great for beginners. You can invest in stocks, options, ETFs right from your phone. You're going to earn interest on uninvested cash with Robinhood. So there are no commission fees or account minimum. So whether you are new to investing and ready to learn, or you just want an easy interface experience, I highly recommend you check out Robinhood. I also will put a link in the description. Alright, this was my basic one-on-one beginner's guide to investing and how to invest. If you have more financial questions that you would like me to make a video about, feel free to leave a comment below. If you enjoyed this video, please like and subscribe. That really helps me a lot. Thank you. I hope this information was helpful, and as usual, thank you so much for watching, and I will see you guys in the next video.